Okay, we are live on Facebook, YouTube, and LinkedIn. Welcome back to the Mobile Mailbox Money Mastermind, the family bank here with the live deal flow market, providing passive investors a seller finance note investment strategy, cash flowing outside complications of landlord and tenant, and cash flowing like Warren Buffett. Normally in the beginning, I have my cohorts here kind of introduce themselves. So I'll do that here. Sonny, if you could just introduce yourself.
Sure. My name is Sunny Finkel, and I am the Investor Relations Specialist for Mobile Mailbox Money and Silvercrest Opportunity Fund. I am also a loan compliance coordinator for Win Mobile Homes, and I help keep all the documents together and the processes moving forward smoothly. I'm happy to help at any time with due diligence or questions about borrowers or documents. Feel free to give me a call anytime, and I will put my contact information in the chat, and I will monitor and answer the chat if anybody has any questions along the line.
And as I do this, we're sharing this across multiple Facebook groups, numbering about 100. So some of you may have actually fumbled upon us that way. So Sonny, one quick frequently asked question from people.
Oh, we've kind of been covering those the last couple of weeks. A lot of the frequently asked questions are what if it's better for a all age park, family park, or a 55 and up park. And we've discussed a little bit about what those differences are. For investors, I think the 55 and up is a little stronger just in the fact that the people in the 55 and up parks are more stable. They're on a fixed income. They don't have a lot of life changes going on. The benefit to a family park is that you have a wider audience of people that you can take borrowers from. So there's a little bit more access that way. The 55 and up parks are a little nicer, have a little bit better amenities. So just different questions like that I get asked sometimes.
James Guajardo, if you could just introduce yourself.
Yeah, James Guajardo here with my voice a little bit shot, but I'm president of Win Mobile Homes and Mobile Mailbox Money. Here to listen in. Alden's doing a great job putting together a great presentation today, and hopefully you guys can learn a lot. And if you have any questions, we have plenty of people to help answer the questions.
And Sean, if you could just introduce yourself for the viewers that don't know you.
Hey, I'm
So Sean, you're super muffled right now, just so you're aware. May need to take those headphones off. We'll have to maybe move on. Sounds like you may be on now.
Can you hear me now?
Yes, I can.
Okay, sorry about that. Sean Gibson with Win Mobile Homes and also Mobile Mailbox Money. I'm an investor relations specialist here. I love helping our investors buy notes, sell notes here, help raise capital as well. One thing about me, like I say every single time, I don't just work with the Alden and James, but I'm also an investor. I put my money where my mouth is. So always looking to help our investors buy and sell notes. And yeah, thank you.
Yeah, so a wide, diverse team here. We've got a couple of our virtual assistants on as well. So we're not just a lender. At the end of the day, we're the largest dealer of manufactured housing in Arizona and vertically integrated to provide you these deals. So it's a back office view really today of the bow of investment strategy in performing seller finance notes. I was going through ChatGPT and asked it to give me a portfolio snapshot of the notes that we've actually taken down over the past 30 days. And that total loan balance is about $711,500. So 711, lucky number. And that monthly payments receivable by deploying that capital is $8,100. So we're doing that like every 30 days right now. That could be a $7 million business here this year, hopefully so. We finished out last year, I think it was like just shy of $4 million, and we net about 20 to 30% on every transaction, as well as, we parlay those exit and margin we make on the fix and flip into a long-term note at the end of the day. So those returns really start to spin up, especially if, we're getting a tremendous amount of velocity, which we are. So I just finished actually the other week presenting at ASREA, Arizona Real Estate Investors Association. And I gave a look and more of an intimate view of what we do on a daily basis to bring these notes to the table. So I'll get to this. We'll talk about some notes that we have currently. We've sold. I'll talk about the ones that we sold quickly as well. But after we talk about our notes today that are actually live and available, we'll get to the creative finance being the bank and how we orchestrate institutional cash flow in manufactured housing. Why manufactured housing? Who's the other major players? How we find homes, what we deem an opportunity, and how we reverse calculate a risk mitigated seller finance note position paying a double-digit interest rate. Here, lot 348, I think we just sold this note this morning, actually. The construction lender who provided us the capital in order to do this transaction actually took the first right of refusal. Sonny, did you do the compliance on this by chance?
I did not process it, but I do have a lot of the information. I was the seller of the note.
Yeah, so let's just talk about what the unpaid balance is, what the monthly payment is.
It was a $80,000 construction note. It was a $99,500 sale, $99,000 sale with $8,000 down. So it's a $91,000 note. So the investor had to come up with an additional $11,000 in order to take the note long term. And I don't see the payment right in front of me.
At 91,000, if I just pull out a mortgage calculator real quick.
And it was a 15%er, not 14.
So at 91,000, that monthly payment for 20 years is $1,198.28. So this investor who came up to the unpaid balance, really his all-in acquisition cost. Sorry, I got you stuck on the closet there. It's a good-looking closet, walk-in closet. This monthly payment is $1,198.28, $1,198.28 over 20 years. A summary on a mortgage calculator really starts to open your eyes a little bit, because for the acquisition cost of $91,000, this investor is not only getting a first lien position with no maintenance, management, insurance, and taxes, but over a 20-year term, the total interest received is $196,000. He doubled his money with one acquisition, coming in at the right place at the right time, and had some capital to deal with. This investor sometimes invests through his IRA. I can't remember if he's doing that or not, but great 20-year cash flow, not only for a potential tax-deferred or tax-free investment strategy, doing that through a qualified solo 401k or IRA investment account, or just really for personal investment, but at one acquisition, he made $196,000 at the end of the day. That's future payments, right? Amortized over a 20-year term. These homes, this ground set fit in a 55 and older community off major cross streets of Broadway and Val Vista. It's a gated, institutionally owned community. Sun Communities owns this park. So that's a Warren Buffett owned community, great aesthetics and things of that nature. This investor is actually a note investor. So likely at some point throughout his 20-year term, he'll either sell that position, borrow against it to recapitalize his portfolio, or a couple other, cool available opportunities like pulling out a partial of capital against that note. Not everyone's a note investor at the end of the day. So for him, that was a super win. He owns now, parked some capital for a long-term strategy, opposed to having to get tapped on the shoulder, once or twice, 3 times a year. That gets kind of exhausting for some people at the end of the day. So that's a great property that just sold. I think we netted like 20-30% on that transaction. We probably made close to $30,000 on that home, just buying it, rehabbing it, and flipping it to seller finance to a underwritten buyer borrower who will live there long term. Note number 2, this one's hot off the press. We talked about this one last week. I had an investor call back this morning. He didn't end up answering, so it's available at the end of the day. La Montana Del Sur. Let me just pull up my notes here.
I am processing this one, so I can answer for you if you like.
Yeah, let's hear about it.
It was a $99,500 sale. They put $3,000 down, so the note is $96,500, and it pays $1,200 a month.
So $96,500. Where can you buy something under $100,000 for an acquisition, or loan your money and actually get? How much is the monthly payment? $1,200.
Yes.
Making $1,200 a year in this. Bucks a month. $1,200 a year over $14,000 a year. I'm getting all confused. $1,200 a month, $14,000 a year in passive cash flow with this quality manufactured home. This home is actually a year. It's a
1998 Cavco. It's a 3.2, 960 square feet. And the incredible thing about this, we talk about the housing cost for affordable housing. The lot rent in this park is only $800. So with her $1,200 a month payment, she's looking at $2,000 a month to own a 1998 home, 3.2, in a nice community where she's happy to raise her family, and she could not rent an apartment for that.
So yeah, her availability of housing, for a fee like this is really slim at the end of the day, to say it in other words. What was the unpaid balance? It was $96,000?
$96,500.
$96,500. This same note, let's get into a creative strategy structure, right? I don't want a 20-year term. I'm sitting on this meeting. I want a 1-year term potential. I want a monthly payment, and I want a double-digit interest rate. I love this deal, right? It's a Dodd-Frank compliant note, which means bank quality stability, and it's backed by a lien. I get 20 years of payments at a double-digit interest rate. I don't want a 20-year term. What is that? Well, for a 1-year term at $96,500, we start cash flowing together. I pledge this consummated, qualified, and quality seller finance note for a 1-year term in order to garnish capital investment. At the unpaid balance of $96,500, a 1-year term times my proposed interest rate paid monthly is $804. So effectively, with the largest dealer of manufactured housing, you're doing a collateralized loan. You're acquiring this position. I'm pledging it in order to garnish capital investment. You still get your collateral, your first lien position, which is highest in the capital stack of any transaction in the nation. And in exchange, you get $804 a month, which a year is just shy of $10,000 a year, $9,650. You hitch your cart to a qualified operator, and I give you either potential liquidity in 1 year from now. Say, hey, congratulations, Mr. Investor, Mrs. Investor. You made close to $10,000 this year in monthly payments. If it worked or not because you were receiving monthly payments, right? We've never missed a payment, just to pref at the end of the day. Would you like to auto rollover so you get an option to continue that contract, right? At the same agreed upon rate, you get an option for liquidity. What is liquidity? Get your money back. I want all of my capital back. I have a daughter going to college. I'm going to Spain, whatever it may be, or we can potentially transfer you into the fund. The fund absorbs these positions pending accreditation. Once accredited, which means $1 million in net worth, or it's $1 million in net worth excluding your personal residence, or $200,000 a year in singular income, $300,000 combined. You could invest in a portfolio of these notes, opposed to one note, one investor. You start to participate in a per unit owner share of, say, 25 positions that are currently performing right now at these agreed upon rates. And that's really the safest, most stable, set it and forget it position. So there's 3 positions in this one note. Someone either buys the unpaid balance at 96.5, they make the full $1,200 monthly payment, they own that position within their portfolio for the 20-year term, right? And they make the full yield. I either sell that note, I hypothecate it for the person that says, hey, I don't want a 20-year term. I'm really looking for more liquidity, but still have the same stability in the collateral, as well as the monthly payment being a double-digit interest rate. That's a hypothecation, which actually had an investor today that was supposed to take that, but didn't end up answering his phone. So, it's a first come, first serve situation. Or I absorb this in the fund with one of the other 25 positions with notes just like this in the Mesa, Tempe, Phoenix, Glendale, Apache Junction market. And in the fund, 506C Reg D, I pay my investors a 10% monthly, a 10% return for a 1-year term paid monthly, a 12% return for a 3-year term paid quarterly. And you're a per unit owner share in the portfolio of notes that are performing. This one's hot off the press. I don't anticipate it to take too long because of the finishes in this property, the underwriting the buyer hit. We went through all of the structural items to ensure that this property was risk mitigated at the end of the day. Does anyone have any questions? Type them in the chat. This deal is available. I think over the past couple weeks we've sold, it was 700,000. In the month before that we did about 500,000. So all of the notes I've talked about in the past couple of weeks have actually been placed with capital investors. Believe it or not, at the end of the day, we do real transactions. We've got multiple of our current investors on here, a few of you that I have yet to meet. Actually, if you're in the Arizona market and you're unaware, Arizona Real Estate Investors Association meets on the second Monday of every month in North Scottsdale, located at venue 8600. And that's at 5 o'clock. Really 5:30. 5 o'clock is more of a setup time, but that's at venue 8600. You can find that anywhere if you just maps it, venue 8600. Why do I bring that up? Because Silvercrest, the accredited fund that we represent here today and that I manage, is currently the main corporate sponsor, and we gave a institutional presentation on how we find these deals, what we deem an opportunity. And I'm actually just kind of going to go through this. It was an hour and 20 minutes, I think, that we went through with questions and stuff like that. But we're going to kind of go through the fast version today and get into a little bit more of the nitty gritty of, why I give all this stuff for free as far as education and let you know our secrets and things like that, because it's an easy business. It's a simple idea, but not an easy business at the end of the day. So, what's the opportunity? Why is manufactured housing such a safe investment strategy, almost being considered recession proof? Well, here's the numbers at the end of the day. With the crisis being created by single family pricing, this is a little outdated because I think the median home price in Arizona is closer to $400,000. So at a $400,000 median single family price, a mortgage rate of around 6%, we've been fluttering, just below, just above. That average monthly payment is $2,700 to $3,000 a month. Sonny touched on it, that the individual buying La Montana was paying rent close to that, $2,700, and that total monthly payment that she's actually paying, including all fees associated with owning that property, is like $2,350 a month. So she's saving $400-$500 a month in owning a quality home in the area that she was wanting. The housing deficit, it says that we're 65,000 units light of what would be deemed a cure to the deficit for housing. Arizona, why Arizona of all things? Limited natural disaster risk. We have easy insurance equations, no earthquakes, not a lot of wildfires. Here in the major metropolitan markets, there's not much brush in the desert to actually catch fire like a California situation, that creates some concern when those factors are in play. Migration. Arizona is a net migration state. We've seen a 30% increase in average income over the past 5 years. There's still a tremendous amount of people moving to this state with widespread manufacturing coming to the valley, worldwide actual business and tech centers, data centers, all flocking to the tax haven of the Arizona legislature, as well as the new desirability of the market. Projected growth. Arizona is supposed to grow by 2055 to 2.6 million more individuals living here in the valley, and with not much alternatives in unaffordability or even being able to qualify for $400,000 purchase prices or $2,000 to $2,500 a month in monthly rent. Where is the buyer to go that has a 580 to 680 credit score that makes less than $100,000 a year, or even at 100 and has some debt? Even at 100, and if you own, 2-3 cars, you got a small family, you're still not able to qualify for a $400,000 purchase. Literally, the middle has disappeared. People, there is no more middle. It's getting wider and wider every day of the week. And how do we position ourselves given the cycle that's going on, the financial market, and what people are really needing at the end of the day? That's manufactured housing, in other words, right? Positioning in manufactured housing. We don't want to own these homes. How do we position ourselves outside of owning these assets, but still providing a solution to the need? So average purchase prices of a new manufactured home is $167,000. The average site built says $470,000. That's nationwide. Obviously used inventory is going to go from anywhere from like 20 to 100 is a good kind of benchmark. And as you get newer homes or more square footage, like a 4-bed, 2-bath in a family park, that price starts to increase. National occupancy. How many people think that if it's a mobile home, it's going to go unoccupied 100% of the time? It's a 94% occupancy rate nationally. That's not just in Arizona. That's accounting the rural areas of the country, like Alabama, somewhere deep in Ohio or something. All those markets are being accounted for, probably dragging down that national occupancy rate. I'd be interested to see what it was case specific for Arizona. The sales velocity, Q1 increase versus prior years, 66%. It's actually increased in demand for housing like this. And the market size, 22 million. That's actually, I think it's 10% of the housing stock nationally. So with little appetite from investors, unless packaged correctly, and 22 million plus doors out in the market, and combining that with every major national news network quoting affordability, at the end of the day being an issue, to me, this seems almost like a generational opportunity. with the cumulative appreciation. Why has appreciation always been a factor in not so much manufactured housing? I asked people previously in the class that we put on, that how many people thought that every mobile home depreciates, and saw, a bunch of hands at the end of the day go up. Well, a fact actually drawn from real data out online using artificial intelligence, scrubbing different data sets, different platforms. The cumulative appreciation from year 2000 to 2024 was 200%. And I actually know from firsthand experience of homes that we were selling in 2019, the same single wide off major cross streets of Ellsworth and Broadway, or Val Vista and Broadway, that we were buying at 3,000, putting like 5,000 into it and selling for 18 to 20. That same single wide's going for 50,000 bucks today. It is a little bit harder of a market today at the end of the day, but providing value within those transactions and knowing that these homes have appreciated is really an interesting concept to kind of develop. So who's the major other players in this asset class? I always say, a little joke is my grandfather, Warren Buffett. It's not really my grandfather, but we're emulating a Warren Buffett investment strategy. A lot of people put their nose up at manufactured housing. Why would I invest in a wobbly wheels unit, a piece of tin? It's on wheels. It can be moved out of the park. Do you think you're smarter than Warren Buffett at the end of the day? Real honest question. Because if Warren Buffett has 5 different businesses in one asset class that everyone and their mother thinks is a depreciating asset and probably a bad investment at the end of the day, to me, that shows writing on the wall of there's a new day and age. People, we're here in 2026. This isn't, the .com series of year 2000. There's a problem, and to someone that is an industry magnate, not only in investment strategy across the board, but also now in manufactured housing, to have all the data in the world, no telling how much they spend in research just to develop these strategies. At the end of the day, I'd be following a Warren Buffett individual. People follow his stocks. People follow, when he sells, when he buys. Well, what he has no interest in selling? It's a literal quote here. We have no interest in selling any of our manufactured housing businesses. We love the economics at the end of the day. So that's writing on the wall at the end of the day for people, looking for other major identifiers to get up off the couch and possibly enter into this program, with Berkshire, 21st Mortgage, Vanderbilt Mortgage, Cavco, and Champion, as well as Clayton. That's not even on here. Really interesting stuff. So why is this a generational opportunity? The affordability gap has gotten to 5x at the end of the day. Rentals have gone up 5 times here in since 2020, really. The supply constraint, mobile home parks aren't such easily available to develop in most markets. Florida is actually a lot more open. Arizona is more of a not open state by any means. Likely need to know the governor or something of that nature to actually get that to a new development. So a net zero at the end of the day, all the parks that are dissolving end up filling the gap of the communities that are being developed. So that's an interesting fact, as there's really a limited supply of these actual communities that are around. And the recession resistance in manufactured housing, that should validate why today, at the end of the day, we're in some uncertain times. I think the other day, $2 trillion got wiped off the stock market because we went to war with Iran. How do I literally or figuratively put money under the couch or under my mattress without losing to inflation? It's a note investment strategy in manufactured housing. So how do we buy these homes? What do we deem a purchase? How do we reverse engineer and calculate if this is affordable for an end user as our after rehab value, and what kind of money do we put into these rehabs to ensure that we're mitigating our risk at the maximum level. Remember, we're not just the lender. We found these homes, we bought them for $3,000 to $35,000. We put $15,000 to $40,000 into them, and our all-in cost was $40,000 to $75,000. We sold that same home for $50,000 to $99,000 in most cases, or a little bit more in the Mesa, Tempe, Phoenix, Glendale, Apache Junction market. And I'm not buying these houses just to buy and flip them. Yes, that's a great strategy, but it's a lot of sweat, a lot of effort, a lot of moving pieces. And at the end of the day, I really just want a return on investment mailed to me like the bank. It's a note that I'm trying to get to. I'm trying to package these up as many as I can to get to my notes, that are paying upwards of $1,000 a month. And as we each house, not to, drive by the fact that we're making $20,000 to $40,000, $50,000 on these flips. That's all fun and games, but then I got to go out and find a whole new opportunity, a whole new house. I got to find a new relationship, and that gets expensive, and it could be exhausting for many. So how do we source deals? Where do I find that $500 to $20,000 acquisition out in the market? We've done over the past 8 years, direct mail. We worked with local dealers. We've worked with park managers, where now we've elevated in the contact tree of these corporate entities that own hundreds of mobile home parks. We're in communication with the number 3 Acalian Properties, the vice president of sales and marketing for Treehouse Group and Roots Management, Equity Lifestyle Solutions, Kingsley Management, and a few others, just to kind of paint a picture. They call us at the end of the day when they repossess homes, when they have people going to eviction that may need a cash offer, will cure their eviction, pay for the house, and get a great deal out of it at the end of the day. It took 8 years really to develop those relationships. Today's March 16th. In 2 weeks, we're taking the number 3 Acalian to the Masters. So I'll be out at the Masters. Hopefully we'll get a picture together. Hopefully I don't forget, a lot of stuff going on that weekend. But, the real business is had in the relationships. I'm not looking for one note transaction with you. I'm not looking for one deal with these institutions. We're a major player looking for really lifelong relationships of people that are looking to either reperform their homes in their community in the Arizona market, or really just look for a passive investment strategy that's outside complications that they normally see out in the market, or they're being offered subpar returns for their participation. So, at the end of the day, I acquired these houses, right? I bought them, I rehabbed them, I sold them on financing, and we have our staff that goes through a third-party underwriting. We collect their financing criteria, get an ability to repay, likely have an all-in basis of $55,000, and I seller financed it at $83,000 at a double-digit interest rate, right? For a 20-year term, getting $1,000 a month in monthly cash flow. What's your 1% rule on $83,000? That's a banger right there. In other words, you're getting over a average return seen in comparable real estate investment strategies. $83,000, $1,080 a month. You can't get that anywhere else in the nation outside of this asset class and in notes like this. And you may know people that provide notes like this, but are they being underwritten? Were they written on a napkin at Starbucks? Did they go through formal processes? Did they have a brand? And are they licensed, bonded, and insured? All really important questions to get out on the table. So when I borrow against these notes, I'm either eliminating my equity buffer and guaranteeing the position via hypothecation, or you're buying that whole position and taking the risk within your portfolio at the unpaid balance. Important to know that any person that buys a note from us at cost will get our back office staff at cost. So it's not a foreclosure, it's a repossession. What does that cost? A repossession is about $750 instead of, having to go find your own attorney at $5,000 out of pocket just to start the relationship, and our sales staff and our rehab staff. So if we have to go in and ultimately repaint the home, clean it out, any of those areas, we have those bells and whistles in case a home goes non-performing. And how do we mitigate non-performance? It's in the underwriting up front, not after the transaction. After the transaction, we make sure before we even get them to the table that they go through 2 rounds of underwriting. Layer 1 is through the community. They get a 600 plus credit score or ITIN number check. No criminal convictions, which is case specific in manufactured housing. You could buy a home on single family and actually have a criminal record. No open bankruptcies, no past evictions. Same thing with evictions. In single family, you could have an eviction and buy a property and get a note on that transaction. Verified income and making sure they're an upstanding citizen at the end of the day. With this second round, it's now you're talking about a conventional underwriting process for a loan that's through Dodd-Frank compliance, through a third party with minimum down payment criteria and debt to income ratios mimicking FHA. So with these 2 rounds, I beg to argue that they're arguably more underwritten than a single family note. It seems kind of blasphemous to many. But here's the proof. I mean, they're getting further underwriting than what would be received in a comparable note strategy at the end of the day. So, structuring the note for compliance, it's important to be above board. We got asked at Jurassic, the Activate and Elevate conferences, how are you guys navigating compliance? What bells and whistles do you have in place to mitigate and stay compliant at the end of the day? So we have a licensed mortgage officer on staff, third-party loan servicing, which is a contract servicing company we use out of Washington, likely either use a title company or our licensed, bonded, and insured dealership to transfer title and make sure we have a clean chain of documents, as well as a third-party underwriter who used to own Call the Underwriter. Dan Deppen currently owns Call the Underwriter, but we are working with one of the previous owners, great relationship with him, at the end of the day. The terms of those contracts, that's where the meat and potatoes is of these transactions. The term of a 15 to 20 year in most cases, because that'll match or beat market rent. Why do we carry paper for that long? At the end of the day, do we feel okay with doing that? Yes. Why? Because Warren Buffett does a 25-year loan. So if Warren Buffett will do a 25-year loan on a home that he never owned, he never saw the inside of, he did an appraisal on at 25 years and that buyer qualified and he'll consummate that transaction, to me, that seems like a winning scenario. Not only did we own this home one step further than Warren Buffett, we actually did a rehab or a 50-item checklist to make sure that this is a risk mitigated transaction. And with our paper, we do no prepayment penalties. We want this to be a win-win situation for all involved, for you to earn a smashing double-digit interest rate, whether for 1 or 20 years, and the buyer borrower for them to match or beat market rent, but also have an option at any time. They could refinance, pay principal down, pay off the property, or even sell the home potentially, depending on how the market looks, for more money, or sell as a break even, depending on how long they've been in the house. So for me, I'm 31. I've done 350 deals. That's $15 million in manufactured home sales and $15 million in private capital raised for those transactions. That's 30
You're going to
million.
have to update those numbers because you've been saying 350 transactions all year, and it's a lot more than that now.
Great point. You know, important to be accurate. It is estimated at the end of the day, but $30 million in transactions. And why am I sitting here today saying I never want to own another thing again? I don't want to own anything. I want passive income backed by collateral. And that's a note strategy where, in comparison of a rental program, you know, every guru, every mother and father in real estate, every grandfather in real estate says buy 10 properties, rent them out, not so much being transparent about the sweat, the tears, the blood that's had with owning that kind of portfolio. Most people don't realize that it's setting it up for a second job at the end of the day. And are we really wanting to be that hands-on of an investor? If you are, there's nothing wrong with that at the end of the day. But most people don't have the time, the know-how, the connections, or even the want to sweat like that at the end of the day. In the comparison, when in a note strategy, you literally have none of the problems associated with the long-term rental strategy. You know, with maintenance, taxes, and insurance, you got a vacancy risk. Management is required, or you hire a management company and you cut into your net operating income. You're getting calls, or you're having to direct calls, you know, whether authorizing a maintenance issue in your collateral is ownership. So you're subject to all fees associated with owning a property, where in notes you have, again, no maintenance, management, insurance, property taxes. You pay the taxes on the income received of the interest on that contract, and that's calculated through automatic funds transfer service that can keep track of third-party contract servicing and amortization schedule and keep you up to date with your taxes. You know, those are really life-changing financial freedom instruments at the end of the day. That's a true financial freedom, not trying to go buy a multifamily complex and, you know, live in one of the units, you know, and house hack. You know, that's all great, but to get to true financial freedom of passive income is really a note investment strategy. And that's really after you've either fulfilled your resources of investing in yourself to get yourself and your business further. You've already tried rental strategies. You've owned 10 single family homes at the end of the day, and you're looking to exit those positions for true financial freedom. So the exit strategy in notes, you know, how do I feel confident saying we have 3 exits in every note? Most people don't know that you can exit a note 3 different ways. You know, what are those different exit strategies for when I buy a note that I saw here today? So number 1, you bought the note, you own it within your portfolio, and you are afforded the blessing of the full yield at a 20-year term. You can actually trade that note on the secondary market, depending on what your relationships are, what your know-how is. We may be able to help you sell that note, or I may even buy it back at some point, depending on what kind of capital we have available. I got a payoff today, $35,000. Thanks, Sonny, for selling that note at the full price. So, you know, nimble, right? You can buy notes, you can sell notes. Most people don't know that. You can sell this position. What else can you do? What's a second exit? You can borrow against this note, not necessarily an exit, but you can pull all of your money out, not have any money left in the transaction, and still perpetually cash flow, right? That looks like hypothecation, which means to pledge a note in order to garnish capital investment. Pledge an asset, a cash flowing position, at less than what the note yields in order to capture capital and still give your investor, your relationship, Uncle Joe or Aunt Mary, who has $1 million sitting on the sideline in a money market account or whatever it may be, and she's looking for a return. You give her 8% and the note yields, say, hypothetically 14. You know, you perpetually cash flow, use the other people's money, give them a collateralized lending opportunity. That way it's all legal, one note, one investor, and you two cash flow together. You have none of your own money left in the transaction, and maybe you go buy another note with that trend, with that capital that you've recaptured. Second exit strategy. The third is a option to sell lump sums. So you could do a $20,000 position on a $100,000 position. Say you just needed to buy a car, or your daughter, put a ding in the door. I put plenty of dings in my doors, needed to recapture and ultimately redeploy. You could borrow against a small portion of that note. You want to be careful of fractionalized investing, which is on here in the middle, because it could be construed as a securities. You want to stay out of gray area. It's important to be above board. Being above board will get you farther in life than trying to do one transaction with a bunch of small investors. Nobody wants to be in the gray at the end of the day. So you could buy a whole note. You could lend on a hypothecated position and participate for a 1-year term at a 1-year term at a monthly distribution for a double-digit interest rate, or invest in the fund. The three areas of participation that could be had on the deals that you may have seen here today. A lot of people don't know, Nate Hare and Directed IRA is on every platform, YouTube, Facebook, LinkedIn, and he is the Vice President of Strategic Relationships at Directed IRA. Directed IRA is one of the largest IRA custodians. I bring that up because they're great friends, great business partners, but also they do a stupid amount of education online for people that did not know that you could invest in these positions using an IRA. It's literally a life-changing strategy when, stocks are going crazy, low yield in bonds, mutual funds are not everybody's thing. Some people really just want money outside the stock market in the private sector, and that's where the tax-deferred or tax-free investment strategy comes in. Depending on account type, I'm not an expert on account types by any means, but Directed IRA, if you look them up online, they're at really a lot of the major RIAs nationally, and we've had him on our channel as well, as well as solo 401ks. So directing your IRAs, solo 401ks. If it's with a current employer, the 401k, I'm told that is unavailable, unfortunately, depending on how big the entity is. You'd have to ask them in order to, self-direct that position. So what's the risk? At the end of the day, there's risk in investment. This isn't bulletproof. Stocks don't just go up. There is a calculated risk being taken, but without risk, there's no reward, So how do we put our capital in a position for calculated risk? In a lean position with double underwriting, you verify their debt to income ratio similar to FHA. 33% is really conservative. We'll go up to FHA style lending guidelines, making sure there's a licensed mortgage officer and Dodd-Frank compliance, and you have your chain of title. Those are really the 7-8 checks for a risk mitigated capital investment in a note. And once you get those check boxes, that's really a decision at the end of the day to be had. Man, it hit 9 out of 10 check boxes. It hit 8 out of 10. That's seems like a risk mitigated program for me. I put this together at Asria because there was a lot of other operators that were in the room kind of looking to try and replicate what we're doing. And I'd love to, kind of just delve into these a little bit about people that may try to replicate what we're doing. Easier said than done. Quick disclaimer, there's risk in investment, and this is not as easy as what it seems. But, week one, if you were wanting to do this kind of business, you form your bank account, your LLC, you interview a couple of RMLOs. You can call Dan Deppin at Call the Underwriter and visit a couple mobile home parks in your market. Evaluate the opportunity, what your average rental rate is in the market, what average purchase prices are. Maybe throw out a couple bandit signs that you buy and sell manufactured housing. It's important to get in relationship with the communities in that area, because the park manager is a make or break relationship at the end of the day. They'll either throw the hatchet at you or, give you good graces. analyzing deals. We analyze probably 30 deals a month. Something tells me that's a pretty high number, but we don't buy them all. But it's a law of numbers. How do you create velocity in order to continue your deal flow, keep your investors happy, keep your debt service happy? You could go out of business trying to debt service when you raise for these homes. At the end of the day, walk a couple properties, submit a couple offers. I make stupid offers all the time. Me and James got off the phone with a wholesaler that was kind of mad at us earlier today. It's just the name of the game. That's business. We're making stupid offers, and at one point something's going to hit. I think we get the best deals in the nation. I care to argue. At the end of the day, conducting due diligence, signing closing documents, and fund and record title, building a pipeline as you see before you. So build the machine or buy the output or fund the factory. At what point do you make a decision of where you want to sit within a transaction, right? Because that's a decision to be had. Do you want to be the operator, which comes with high effort, maximum control, requires construction skill, and is the highest level of risk, high risk, high reward, right? At the end of the day, do you want to position yourself at the top of the capital stack and position yourself after all the hard work has been taking place? This guy went out and rehabbed the house. He found John. He underwrote John. I'm really just going to lend my money at a double-digit interest rate backed by performing collateral because I like the business. I want little exposure. I want some risk because I want a return at the end of the day. That's where you buy that note or lend on a note or fund the factory. You become an accredited investor. You pool your risk. So across multiple notes, cash flowing here in the Arizona market, and you either get a monthly or quarterly distribution. We've been to every major national note investment conference, most of the note investment conferences, most of the RIAs, had podcast vlogs and masterminds over the past 3 years. And most people are non-accredited and they fall into the buy the output position. They become a note investor or they lend to one of the largest qualified operators in the nation in the asset class. So, Mesa, not so much Tucson, but Apache Junction, all areas in markets that we deem a risk mitigated market, a move to market, the absorption for these units, if they do go vacant, we feel comfortable with what that turnaround time looks at. So from originating the note, seasoning the note, selling the note, and repeating that cycle, that truly creates a full ecosystem and hopefully provides you a better understanding of our relationships in the valley, our deal flow, how we find homes, why this is not just a lending strategy. We package these homes for the want for true financial freedom, risk mitigation, and where to earn an above average return in a market like this without having to travel the nation and build these relationships or pay a $50,000 education fee in order to conduct a transaction before you even make any profit at the end of the day. If you are accredited, we have multiple positions that we have the availability to absorb right now. I could put a minimum $50,000 to $1 million to work in as little as 30 days. I made a post the other day looking for 10 and $20 million, and I had a lot of people reaching out. So hopefully I'll hit a larger number here soon. We have 1.56 million currently working. It's all performing. We had one note, I think, actually go behind a little bit, but she caught up. Housing is one of the most resilient asset classes in investment strategy today. At the end of the day, necessity, there's a need for these homes. There's a problem out in the market, and we've positioned ourselves to create $800,000 a month in paper with an annual interest gross of $112,000. I'm literally making a pro forma mobile home park every year. Mic drop. Where can you create a mobile home park every year at pro forma? That's what we call mobile mailbox money. So, I always put out my personal information. This was being streamed live on all platforms. Let me get out of this screen here. Got a bunch of interactions going, bunch of hearts. Hopefully I did justice of Warren Buffett's investment strategy. We've sold 10 to 15 notes over the past 60 days, truly life-changing, and it's all collective at the end of the day. This is not me touting, standing on my milk crate at the end of the day. This is a team effort. It's a collective approach to solving a need in a feel-good investment strategy and making above average returns. And, with that comes the cultivation of these relationships. We do a tremendous amount of advertising, online co-branding. We've been and had major industry magnates like Arizona Real Estate Investors Association, Mike Del Prete, who's running for city council on our channel, Nate Hare, Patrick Franz of the Note Investor University, Mark Monroe of the largest creative finance Facebook group in the nation. I've had Eddie Speed. I've had vlogs at Paper Trail, Note Expo, Diversified Mortgage Expo, Elevate and Activate with Anthony Gerasi, the largest private lending law firm in the nation. The list goes on. These notes, lot 126, La Montana, $96,000, $1,200 a month. I'm looking for a partner on that deal. Please don't hesitate to reach out. We went through a lot today. It's actually 159. Does anyone have any last questions here? That was good timing. That's great information, Alden. Thanks so much for your participation today, everybody. We'll see you next week. I'm going to put my phone number in here real quick. I'd love for one of you to reach out, just talk about the opportunity, figure out how we can get comfortable and start cash flowing in as little as 30 days. Thanks so much for being here. We'll see you next week. That's one step closer to financial freedom. What do we call that? Mobile mailbox money. So that's how
Thanks,
we
everyone.
do it. 56 minutes. That was a live look. Looking for capital. Invest today with Silvercrest Opportunity Fund.